The following presentation is in regards to the Flux Multi-Instrument-Histogram analysis. Today is August 3rd, 2017. My name is Michael, and I will be your host for the next 40 minutes or so with regards to the multi-instrument histogram analysis upgrade for the Flux histograms indicator. The thing I want to start out with is in regards to the dominance of certain markets in terms of their ability to drive other markets at certain times. And two of those markets that we've discovered over the last 10 years or so that have a dominating effect in regards to pushing markets higher or lower at certain times include commodities such as oil futures and gold futures. Now, it's no secret if you're a customer and you've been in my room regarding this, as I've shared it freely now for the past 5+ years of the discovery that we're discussing here today. But previously, we've never been able to cross over from one instrument to another with regards to histogram analyses. That is to say, if we wanted to put the histogram from one instrument on another instrument, we always had difficulty with that. And those of you that know us and have been in the Flux family for some time, you'll know that we have a track record of taking what a platform should be able to do and pushing the programmers, for example, at NinjaTrader for answers to questions they didn't ever think to even ask. And so I would think in terms of what NinjaTrader's software was designed to do, we've found the edge of what it was designed to do and pushed it. And one of the boundaries that we never successfully or had real permission to puncture was this ability that I'm talking to you about to transfer the histogram times from a secondary market on top of the primary market. Now, why would we want to do that? What is it about this concept that is so interesting? And I've developed a workspace here today. I can't remember which one of these it was. I think it was this one. Yep. So let's get right to the nitty-gritty. This chart on my screen is the culmination of 5 years of observation and 2 years of development. And at first it appears like a normal Flux chart. It has a Flux histograms indicator on the bottom for both the power zone or the 120 SMA filter, as well as the MACD, or in this case a 5/7 stochastic filter. Now, what's immediately different though, just under the surface, is the base instrument that's being referenced for the times. So if you'll notice with me, I'm going to highlight it in the lower corners here. You'll see that for the very first time you have the ability to reference a secondary instrument for timing patterns. And in this case, that instrument is the one that we were just looking at, the one that is so accurate in and of and by itself, being oil futures, crude futures. And so all of these pieces of information, all of the data on the bottom of the chart is the answer to the question on a 3-minute time frame. When does crude futures have a tendency lately, over the last X number of thousands of bars, when does it have a tendency to go up or down? And we have that now underneath the NQ live price action. And so one of the things that will immediately stand out to you if you haven't already had an epiphany is that all of these signals are coming from crude futures. In this case, the CL September contract 3-minute chart. Now, if we'd left this base instrument empty, there would be a different effect altogether. So if I come in here and I change the base instrument and I leave it blank, you'll notice that the dots aren't the same. We're missing some signals, in fact. Some of the stuff isn't quite right. But if I go back and I reference the CL contract and the crude histograms underneath, watch what fills back in. You see those chimes? It got more accurate. It got more accurate. Okay. Now, one of the markets that I've been using this almost exclusively on now for going on 2 years is the E-mini S&P. It is, in my opinion, one of the most manipulated and one of the most difficult markets to analyze and project. And so in this case, you'll see on a 5-minute chart, I've brought those same crude futures histogram times on top of the E-mini S&P price bars. And we can do this on a 5-minute chart. We can do this on a 60-minute chart. And if we do it on a 60, we just have to change the base time frame. So as we go deeper, this is sort of the very first step of the staircase on the way down. You'll start to notice that we have all sorts of possibilities. Let's get rid of this drawing tool here. So now on a 60-minute time frame, we're rapidly approaching this too good to be true idea of what's happening and what's projected. And here's what's I find bizarre. Every signal on this chart is based on a 1-week-old crude futures projection on top of the E-mini S&P. And so if we expand that back, you'll start to see how relevant something like this is. How relevant something like this is. For example, if I just suppress the trend histogram, you'll see that there are actually some subtleties here that are being followed in the crude histogram itself. So by that I mean this. If I come over here and I check, you'll see that there's a double bump to this histogram here. There's kind of a valley and then a peak up. Can you guys see that? So there's a valley over here and then there's a peak. It's subtle in the geometry of the histogram, but I want you to see this. Even with that subtle geometry, look at how the ES follows the curve of the histogram. And now you can see what's coming up here: a selling pressure signal at 10 o'clock, a buying pressure signal tonight at 2 a.m. Eastern Time. But again, all of these signals for the E-mini S&P are based upon a 1-week old forecast of crude futures. We're mixing the streams, or crossing the streams if you're a movie aficionado like me. We're doing something. Cats are marrying dogs here. This is an interracial analysis. We're bringing two markets that, for all intents and purposes, should have nothing to do with each other, and we're squeezing the best of each out and overlaying it on top of each other. Now, there are two markets that I've found that work really well on the ES as a driver. One of them, of course, is crude, but we can always come back and analyze gold futures. Gold and crude are dominant in regards to the indices. And so if I wanted to see what, if any, net effect gold futures would have on the S&P, I could simply come in here and change everything. And did you notice that when I changed everything from CL to GC, that the chart got clearer? The chart got clearer, right? It wasn't as messy. The signals seemed to be in the right place. And never before have you been able to perform a study this quickly to see which market is truly driving the one that you're following. And so, having gone on a 60-minute chart between the two markets, it would appear that GC is the dominant of the two. It's the dominant of the two. Now, if you were going to go full bore, could you put both the GC and the CL histograms on the same chart? Want to try it? Sure. Okay, let's take these little doodads out. And I'm going to just set this as default and bring it in a second time. So watch how quickly Flux histograms, multi-instrument analysis, watch how quickly we're able to do an analysis of CL in conjunction with the gold analysis. So we should have two new histograms on here, and we do. So we have GC 1217, the September contract of gold futures, and then we also have the CL signals down below. And right off the bat, we start to see that there are some graphical relationships, some interdependencies that are kicking in. And one of the things that we can do is just sort of expand everything out and give it room to breathe. So what I'll do here is I'll put all of the momentum analyses near each other. So we'll put the A-Stokes for gold and crude on top of each other. And now we've got the trend histograms for gold and crude on top of each other down below. And so you start to see that there are some confluences that build up, right? And remember, gold is the one that is driving right now. Gold is the one that is driving right now. So for this morning, as we look at the signals here together, the 12 o'clock signal from gold is the one that drove everything back up into this high right here. So we see that the stochastic in regards to this indicator is looking at CL. So let's go ahead and put the CL A Stoke on top of here. And we'll start to change colors. So Flux time cycle markers, CL 0917. And now we'll change the color of the dot. Instead of green, let's make it cyan. Instead of red, let's make it magenta. And let's change the marker separation from 3 to like 5. So any magenta and cyan dots now are going to be coming from this histogram down below. Matter of fact, let's change that histogram for CL to cyan and magenta, just so we know where the dots are coming from. Okay, so now look at what we've done here. We're building and we're keeping what works, and then we're stripping away what we don't want. So right now, we don't have the trend dots on for Crude because they're not as powerful as the trend dots are for gold. But the momentum dots for Crude are keeping pace with the momentum dots for oil. So we were able to take two different instruments that are completely unrelated to the primary being the E-mini S&P, and we were able to discover virtually every one of the pivot points have a marker represented in the actual structure of the moves. And so we're sort of filling in almost every one of the blanks at this point, right? Right down to the breakouts and the pullbacks and the highs. So any questions about what we've done here so far? Because this is a very powerful technique in uncovering patterns in markets that you're focused on. Now, if you're looking at 13 different markets, it's going to be very hard to do this and really drill down deeply into one market. But in this case, when you're looking at a basket of 2 or 3, the ability to discern these types of interrelationships gets much easier because your focus is a laser or a rifle-like focus as opposed to a flashlight or a shotgun approach. Now, this will work on higher time frames, and as we discussed here for the NQ, it's working on lower time frames. That is to say, we've discovered an interdependency that the banks are subjected to, that they're sort of slaves to. And I like anything that the banks are subjected to, because if they have to do it, I want to take advantage of that behavior pattern. I want to take advantage of that behavior pattern. And so the ability to put these histograms on top of the price action of another instrument is critical when the market is as manipulated as some of these are. So any of these markets that are indices, that are not a primary market like wheat or corn or gold or silver or home heating oil or natural gas or oil, all of these things beyond that will benefit immediately from an intermarket analysis. In fact, I haven't looked at an ES chart without oil on it now for over a year. I couldn't go back to the way it used to be. I would be mad for the loss of sensitivity in the accuracy of the signals. So let's stop here for a second, because we can go even further with this. And I want to show you a really nice way of balancing your Forex trades as well. So I'm going to save this template. And I want to change one of the instruments in my instrument manager, and that would be copper. Okay, copper is good. Let's go ahead and open a new chart. In this case, the Australian dollar on a 60-minute time frame. Give that a chance to load up. Rick, the question was asked during the webinar, are you saying that the banks are moving money from gold or oil to the S&P instead of cash? No, I'm not saying that at all, though I could understand how it might be interpreted that way. What I'm saying is that there are two standards of value in the world right now, and the nations and/or companies derive their value from amassing quantities of those driver instruments. So, for example, in the past, it would be evident to say if you have more gold, if a nation has more gold, or let's say a corporation stores reserves of gold for some reason, then the value of that company goes up, or the value of that country's economy goes up. There's a new player in town too. If there's a corporation that is heavily invested in the value of crude, or let's say, for example, you're Apple. Rick, how might the value of your stock be directly related to the price of oil? Well, Apple uses a considerable amount of petroleum for what? The plastics in their products. They use a considerable amount of petroleum for what? For the distribution. You have the diesel fuel for the ocean rigs, and you have the diesel fuel for the UPS trucks that deliver your products all over the country. So what I am saying is that the value of everything is in some way, shape, or form derived to a natural commodity. And the two commodities that wars are fought over historically have either been gold, and more recently in current events, oil. And the more of it you have, the more value you bring to the markets. Does that make sense, everybody? Okay. Or the evidence seems to bear that out. Now, one of the pairs that I did an analysis for that we're going to open up, there are actually several that benefit from this, but one of the ones that I found has a strong primary correlation is the Australian US dollar. And a quick show of hands, how many of you know what Australia is known for in terms of exports? Well, a quick Google search. It's a major exporter of agricultural products, particularly wheat and wool, minerals such as iron and gold, and energy in the forms of liquefied natural gas. Okay, that's kind of huge, right? Matter of fact, that's worthy of a screenshot. So we'll go ahead and save this. as a BMP file. And let's go ahead and open that up. You just keep it in the corner. Yeah, I know. You just want to be heard. Okay, so there's our Australian products. So let me come in here and change or turn off all these other workspaces, if that's all right. Holy cow. File, workspace, close workspace. No. Let's go ahead and close this one. File, workspace, close workspace. No. We're going to leave this one here because this is one that we actually have this working on for the DAX. There's our 60-minute. Okay. So we cleared up a lot of memory there. Okay. Let's take a look at some of these things. So we've got the Australian dollar, and we have the ability now to check things. So one of the first things I'm going to do, while I can appreciate the value of oil in relation to the Australian economy, I want to see what gold can do. Instead of what can brown do for you, let's see what gold can do. And I think for the purposes of this example, I'm only going to use one histogram. And I think that will help us focus better. So we'll get rid of the power zone filter, and we're just going to use the MACD filter now, or I'm sorry, the stochastic filter. Question. It appears, but you guys can help me with this, it appears that gold has an effect on the value of the Australian dollar. That is to say, if we put gold futures on the bottom and we overlay that information on the top, there appears to be a direct correlation between when the prices of gold are supposed to go up or down and when this market goes up or down. All right, so that's the first thing. We'll kind of put a pin in that and come back to it. Oh, actually, I still had the gold. I still had crude on there. I made a mistake. Sorry. I'd only changed it in one of them. So GC 1217, GC 1217. This will be different. That's a little better, Rick. That's a little better, Rich. Okay. So this is an analysis of gold on top of the Australian dollar. And this seems to have a very pronounced effect, way more than crude did. So Richard, it was actually good I made that mistake because I got to see the difference. Now, one of the other things that you'll notice is these micro patterns tend to have the same effect. So over here, you guys know this as a pattern 3, a chop zone. And so if I cover up that chop zone over here, and we take that out of the loop, if I cover up that chop zone and we take that out of the loop, you'll see that this is even more predictable in that classic sense, right? It's even more predictable. And then the other thing that we used as a gauge, Rich, earlier was what are the micro geometries of the market tell us? So right here, can everybody see the histogram kind of pulls back and drops away? So I'm going to put a red arrow right here. And you'll see that on the very top of that is another push down. It's another leg down. And so it's encouraging to see that gold has an incredibly predictive effect on the price of the Australian dollar. Now, I didn't stop there when I did my analysis. In fact, we have other markets that we can analyze. And I just chose a 15-minute chart because I know a lot of Forex guys will look at that sort of as their lowest time frame. But now on here, I put copper. And so if we blow this out and take a look at it in detail, is there an effect on the value of the dollar versus the Australian dollar, against when copper prices move? Yeah, a little bit. But we're not limited to that. In fact, our instruments indicated that they also have wheat and corn, right? And soybeans. So ZW, ZS, ZC. Let's try all of those and see which one does the market seem to care about the most. So let's try corn. And we'll see with the multi-instrument analysis histogram that one seems to have the most pronounced effect so far. Is that fair? Corn, crude, and gold seems to have the most pronounced effect so far. These are patterns that we're familiar with. For example, if you follow me in my room, you know that this right here is a Canaveral pattern. And if we were following this or tracking this in the room, this would have been a selling pressure signal right there. So corn prices on the Australian dollar in comparison to the original Australian dollar seems to have the most pronounced effect on the value of the one currency against the other so far, and more so than the original currency's timing patterns. Well, let's try the same thing with soybeans, ZS, and see if those same effects occur. Soybeans do not have as pronounced of an effect on the value of the Aussie against the dollar. Okay, let's try one more. Let's try wheat. Okay, wheat has an effect. So what we can do now, which I think is really interesting, I can take the chart that we've got and I can duplicate it. Matter of fact, let's just take the drawing tools off and save this template. And we'll create a new chart. The Aussie dollar on a 15-minute chart with the indicators that we just created over here. Okay, so we knew corn was the other one that had a pronounced effect, so we'll just come back and we'll put ZC on top. Okay, and now when I'm trading this, I can see the times coming up in the future on the Aussie dollar that are interesting to me. And I could overlay these two on top, but I see 945. Between 8:30 and 9:45, I'm expecting buying pressure, right? And then 10:30 to 11:15, I'm expecting more selling pressure. So the market has been down for quite some time, right? It's been down off of that high. And so if I'm expecting another push down, I would expect to see that coming into 11:15, 10:30 into 11:15. One of the things I can also notice looking at the Australian dollar is a shift in the narrative of that market. The trend has been down. It's been down for a while. But in regards to wheat, we violated the 7:30 selling pressure time. The market was anticipated to go lower. The same thing as the 4:45 time. It was anticipated to go lower. And it appears that the trend was over right here. So as of this punctuation, the trend in terms of time in relation to wheat was up. So the trend is up in relation to times in relation to wheat because these selling pressure times are being ignored. Now, the same thing started to happen with regards to corn. We blew through the 4:45 signal right here. There's nobody home. We were expecting it to push down, just like we were expecting price to stay below the dot, like it did over here. But over here, it didn't stay below the dot. So in both of those markets, we've seen a shift in the narrative. And so I would anticipate coming into 9:45 and 10:30, another breach, another push up using that same technique. But in relation to the original Australian dollar timing, we find that if we compared it to gold, if we compared it to copper, if we compare it to wheat or corn, then wheat or corn wins in terms of the value of that economy seems to have the most or the largest anchor in these predictive times. The question was asked, could you do a CAD or JPY chart with Crude? Sure. Matter of fact, that's sort of the next logical example. Canada, of course, having a huge crude, no pun intended, export market. So we just changed the base instrument, and Stephen, your suspicions are correct, right? If we look here at the times coming up in the future in relation to what's occurred all morning, there is a pronounced effect of the value of oil and the times that those values are supposed to change in relation to the price of CAD. And that's made possible by this multi-instrument histogram analysis down here below. If we wanted to check the JPY, let's come down here, find it. Now this is very interesting. Stephen, I didn't change the analysis it was referencing. Remember what this chart was referencing on the right in relation to the dollar yen? What instrument were we using as a driver down below? Corn. I would never have anticipated the value of the dollar against the yen being as influenced as it is by corn futures. That seems kind of weird, doesn't it? So one of the things that the Flux Multi-Instrument-Histogram analysis tool does is it allows you, via the curiosity of a child, to discern patterns you would normally not search for. You didn't know to even look because you didn't have the ability to look without the upgrade, without this add-on. But now that you have the add-on, it's like a car that you've never driven before, and you sit down in the front seat and say, let's see what this baby can do. Let's see what this button does. And the more we look at it, the more we see there's a pronounced effect in the value of the two currencies in relation to the price of corn. I never would have expected to see that. Straight up to and including the patterns that we use in our histogram guidebook, in this case, a pattern 5 signal at the highest high. So if we wanted to check and see if oil had an effect on the dollar-yen, or we wanted to guess if we traded the dollar-yen, which one of the two had the more pronounced effects, oil or corn, we would just change the instrument and compare. So, Stephen, do they both have an effect? It appears that oil and corn prices both have an effect, those timing patterns, on the value of the dollar versus the yen. However, the one on the right, if we use the global crosshair tool, corn seemed to find the bottom at 830. Where down here on the CL histogram, do you see how, Stephen, it was only a divot? It never crossed the zero line there. Conversely, the one for crude found that high at 1210 that this other one didn't find. And so there's a harmony here. Not an e-harmony, like you're going to date somebody and marry him someday, but a harmony in the sense that we can see confluence coming up. We have the ability to try more trades, and we see things that the other markets don't, like the 8 o'clock drop on the left with no 8 o'clock drop on the right. So, in conclusion, there are an innumerable number of combinations that can be tested. And the best part of this is I can virtually guarantee when you do an analysis like this, you'll discover combinations that you'd never anticipated before. You'll discover markets that you didn't expect to see a relationship. So, for example, Thomas, we could apply multiple pairs on one chart. So we could put the pound yen on the dollar yen and see if its results are better or worse. We could put the dollar franc on top of the pound dollar and see if it drives that pair. We can, in the span of an hour or two in one afternoon, significantly affect the accuracy of our predictions simply by using one additional module, one additional upgrade. And again, if we're focusing on a market, determine very quickly where those high probability points lay and what to watch for. So now looking at the dollar yen, I can very easily see that we're coming into a selling pressure histogram on the left, and we're coming into one over here at 1030. So I expect this market to pull back, probably to structure. Somewhere in this span of time by over here. So that would be a good target using crude futures and gold futures, corn futures, as a guidance for the driver of that market. We also, again, we studied the ability to put this on the indices, in this case the E-mini S&P. As we're watching that moving forward today, we can see that coming into 10 o'clock, there's another wall. There's another selling pressure wall going all the way down to this leading histogram down below. So whether it's an American index, a foreign pair, whether it's corn or oil, my advice is use a commodity, a naturally occurring mineral or substance that's grown or distilled from the natural resources of the earth, and use that as an underlayment. Use that as the base for whatever you are analyzing. As you get more advanced, do multi-instrument analyses. Put the NASDAQ and the mini Dow and the mini Russell on top of the ES. Put the three major pairs of the four underneath the fourth. Try the Brazilian real to sugar. Sure, Richard, these are all wonderful things. Sugar, orange juice, coffee. You're starting to get the point. But the point is, I want you to have the tool. And so today I've done something pretty cool. I'm going to give you a link. Lila, you could in theory create an HPE line with this, yes. So Lila, you would, instead of a histogram, you would change that to a line, right? Instead of a bar. And you could do multiple lines, right? That's kind of what you're insinuating, right? So Lila, you could have the corn line and the crude line and the gold line on the same chart and build it like an HPE chart. It's the only difference. An HPE chart is just a histo that's a line and up top. So you could absolutely do that. Matter of fact, let's leave it there and kind of close up, because I think that's the most advanced idea that we're going to look at. Mod says, will correlations change? I don't think so. Mod, I've been looking at CL on ES now for so long, but I don't think mods will change so much as you'll change your perception and you're more inclined to try things because you have the ability to look. Yeah, Lila, you can do all of those things, but you can't do them with a multi-instrument analysis without this tool. So where do we go from here? Look in your GoToWebinar chat box. Well, I'm going to stop the recording here. If you have any questions watching this video on YouTube, please feel free to reach out to me, Michael at backtothefuturetrading.com.